Hi, I'm Joe Walton, and I'd like to spend a few moments to familiarize you with the Capital Gains Bypass Plan. I hope you'll find the information beneficial to both you and your family. But first, I'd like to introduce you to the T.J. Martell Foundation. In 1974, 19-year-old T.J. Martell was fighting for his life against childhood leukemia. Toward the end of his life, young T.J. asked his father, record executive Tony Martell, to help his doctor, James F. Holland, of New York City's Mount Sinai Medical Center, raise funds to find a cure for leukemia. With the help of other music industry executives, Tony promised his son that money would be raised to someday find a cure for leukemia and other forms of cancer. In honor of that promise, the T.J. Martell Foundation was formed. Through the years, that promise has grown and flourished, with proceeds of over $75 million dedicated to research, offering hope and life in the fight against leukemia, cancer, and AIDS. The Martell mission is to raise funds to enable researchers to explore new pathways, unencumbered by grant restrictions. Contributions fund innovative research at Foundation laboratories located in major medical centers, including Mount Sinai and Memorial Sloan Kettering in New York, the Neil Bogart Memorial Laboratories at Children's Hospital Los Angeles, the Francis Williams Preston Laboratory at Vanderbilt University in Nashville, and many others. Your support can make a significant contribution in the search for a cure for leukemia, pediatric, breast and prostate cancers, and AIDS, while minimizing your family's exposure to capital gains taxes. You're going to meet financial planner Bill Clayton. He will explain how the plan works and if it might be right for you and your family. We hope you'll find the plan to be mutually beneficial.
Hi, I'm Bill Clayton, and I'd like to spend a few moments with you to discuss the Capital Gains Bypass Plan. I hope you'll find the information beneficial to both you and your family. This plan was established by Congress to specifically aid charities with the Internal Revenue Code, Section 664, which has been in the tax code for over 20 years. Let's take a look at the circumstances of Tony and Pat Rogers. Tony and Pat are age 72 and 69, respectively, and are in good health and have recently retired. One major asset in their estate is a 15-unit apartment building which they purchased 20 years ago. They are currently managing the building, but would prefer to be rid of the management responsibilities and enjoy their retirement. The original purchase price was $56,000, and through the years they have had ongoing improvements, and they have taken the standard depreciation allowances. Today, their adjusted cost basis in the property is $100,000. The current fair market value of the property is $1 million. If they sold the building, they would be facing a capital gain of $900,000. The Capital Gains Bypass Plan, also known as the Charitable Remainder Unit Trust, or Bypass Trust, is a powerful planning strategy for avoiding capital gains taxes. I'm meeting now with Pat and Tony. We're going to discuss how the Capital Gains Bypass Plan may be beneficial to them.
Hi, Bill.
Hi there.
Tony and Pat, how are you?
Good, thank you.
Let's take a few minutes to talk about your objectives and concerns regarding your apartment building and overall estate plan.
Well, first of all, we want out of the apartment business. The income's been good and the appreciation on the property has been significant, but the fact of the matter is that we're tired of managing the apartment building ourselves.
We'd like to travel while we're still healthy and active. But with maintenance and tenant responsibilities, it seems like we rarely have any time to plan for our own lives.
I understand. I have many clients who feel the same way you do.
Because of the appreciation on our property, if we sell the building outright, we are looking at huge capital gains taxes. And I cannot bear the thought of giving so much of our hard-earned money to the government.
That's a major benefit of the Capital Gains Bypass Plan. It retains more of your financial assets, both for your retirement and for your heirs. By using Tony and Pat's situation, Let's compare the differences in selling their apartment outright and taking the capital gains tax and selling the property using the bypass plan. The facts are as follows. In selling the property outright, the sales price is assumed at $1 million, net of selling expenses. The adjusted cost basis, which is the original price plus improvements, less depreciation, is determined at $100,000. This leaves Tony and Pat with a capital gain of $900,000. Conservatively estimating their combined state and federal capital gains tax rate of 33%, they would be forced to pay $300,000 or more in capital gains taxes, thereby leaving them with only $700,000 to reinvest. Assuming that they could reinvest the $700,000 at 8%, they would receive $56,000 in taxable income annually. In contrast, by using the bypass plan, Tony and Pat would eliminate the $300,000 in capital gains taxes, and their trust would have the full $1 million to reinvest to generate more retirement income. Assuming an 8% income from the trust, Tony and Pat would receive $80,000 in taxable income annually, or $24,000 more in income each year for the rest of their lives.
We're concerned about our retirement. We have to count on that income to maintain our quality of life and to do some of the things we want to do.
This plan allows you to determine how much income you receive, and you can have as little or as much control as you like in the investment decisions of the trust.
Well, how often do we receive the income from the trust?
Most people choose to receive their trust distribution on a quarterly basis. However, you can choose to receive the income monthly, quarterly, semi-annually, or annually.
Well, aren't we in fact just giving our property to charity and hoping for the best?
I'm often asked that question. Let me tell you how it works. The bypass trust is set up in your name. You can transfer the property to the trust at your discretion prior to the sale. Then you and Pat receive all the benefits of the trust during your lifetime, including all income and tax advantages. You also retain the right to change trustees or co-trustees if they don't do a good job for you. The charity that you select as a beneficiary does not receive the trust assets until the surviving spouse passes away. Sometimes it's advisable to appoint the charity you've selected as a beneficiary to be the trustee or co-trustee with you in managing the trust.
Why would we do that?
If you choose a charity that has the expertise and experience with this planning process, they may assist you in covering the costs associated with establishing this plan.
That sounds great. But we just gave away our apartment building to charity. What happens to our children's inheritance?
Well, the second part of the plan, the Wealth Replacement Trust, acquires survivorship life insurance, which passes the full benefit of the apartment on to your children tax-free.
But at our age, how can we afford $1 million of life insurance?
When you transfer the apartment building to the trust, the IRS allows you to receive a substantial charitable tax deduction. The tax savings created by the tax deduction, or sometimes a small portion of the increased income from the bypass trust, funds the survivorship life insurance. Let me show you how it works. At Tony and Pat's age, a one-time premium of $170,000 fully replaces $1 million to their family tax-free. The cost of survivorship life insurance is dependent upon your overall health situation, and Tony and Pat are in good health. The tax savings generated by the $234,000 tax deduction is $85,000, which they have a total of 6 years to use. The only restriction to the use of this deduction is that it cannot exceed 30% of their adjusted gross income in any given year. Assuming that they could use their entire charitable tax deduction, their net cost to replace $1 million, estate and income tax-free to their family, is $85,000, paid for by the increased income from the bypass trust. We also need to consider the estate tax consequences on Tony and Pat's property in transferring its value to their family. If Tony and Pat sold their property outright, paying the capital gains taxes, and the principal from their net sales proceeds of $700,000 remained in their estate, upon their passing, their estate would have to pay a 50% estate tax, assuming this principal exceeded their federal unified credit exemption of $600,000 under current tax law. After a $350,000 estate tax, the net proceeds to their family would be only $350,000. On the other hand, by funding the Wealth Replacement Trust with a $1 million survivorship life insurance policy, Tony and Pat's estate would pay no estate taxes on this asset because the life insurance policy was properly held outside of their estate. Their family would then receive the full $1 million in net proceeds free of estate taxes. As you can see, the benefits of the Wealth Replacement Trust are enormous if your goal is to preserve and transfer more of your estate to your family.
But I'm concerned about the value of the apartment building right now. Does it make sense to sell while property values are so low?
The decision about when to sell your property is up to you. In some cases, some people will fund these trusts and continue to manage the property until the appropriate time to sell. However, in using the capital gains bypass plan, by eliminating the capital gains tax consequences of the sale, you can lower the sales price and still net more money and lifetime income. Let's review the important aspects of the plans, using the figures representing your situation. To summarize the benefits for you in using the capital gains bypass plan on the sale of your property, you would save $300,000 in capital gains taxes, increase your spendable income by 43% every year for the rest of your lives, allows the transfer of the full value of the asset to your family free of estate and income taxes, and makes a significant future gift to charity, thus leaving a legacy in the name of your family to the nonprofit institution of your choice.
That sounds like a very interesting idea.
Good to see you again.
We'll be calling.
Thanks for your time. In this planning process, it's extremely important that you and your professional advisors do a thorough investigation to determine whether or not this plan is right for you. You will need to consider your particular assets, your income needs, and what your overall tax and financial situation is, both now and in the future.
Thanks, Bill. Pat and Tony's situation is one of the many types of scenarios resulting in a capital gains tax dilemma. If you would like more information or would like to schedule a complimentary consultation regarding your specific financial situation, please contact the professionals at the T.J. Martell Foundation. Our toll-free number is 1-800-309-FUND. That's 1-800-309-3863. Or write to the T.J. Martell Foundation Charitable Estate Planning Department at 338 North Foothill Road, Beverly Hills, California, 90210. In utilizing this plan, you'll be helping Tony Martell fulfill his promise to his son, while saving your family from paying unnecessary capital gains taxes. All inquiries are completely confidential, and we welcome the opportunity to assist in developing a plan that is just right for you and your family. Thank you very much.